We're thrilled to be able to have Hugh Johnson on the call today. Hugh is Chairman and Chief Economist of Hugh Johnson Economics, a longtime board member of Pursuit, a very well-known and respected economist. There's been some wonderful recent announcements that have had some positive impact on the overall economy as well as the outlook, and thought it'd be appropriate to have Hugh's comments. Hugh, if you wouldn't mind, give us an overview of what you have heard over the last 48, 72 hours and how that's going to impact business borrowing decisions in the future.
Yeah, there's a lot that's happened, and I would add that ordinarily we don't get big surprises from the Federal Reserve, but I would say this time we've gotten a fairly substantial surprise. At the start of it, the Federal Reserve, of course, met this week, and what they decided to do is to leave interest rates unchanged at their meeting this week. And that was widely expected. So that was not where the big surprise was. The big surprise is they got around to talking a little bit about what they're likely to do in 2024, 25, and 26. And they told us that they're likely to be, or there's a good chance, not a certainty, but a good chance that there are going to be 3 interest rate cuts or reductions coming in 2024. It's hard to get the timing right, but nevertheless, that's what they're telling us. So the federal funds rate, their target now 5.375. They'll be coming down probably in 3 steps in 2024. It's anybody's guess what the timing of those reductions are going to be. I've seen a lot of estimates or forecasts that their first reductions coming in March. I think it's probably more sensible or rational to forecast that they're going to likely reduce interest rates by 25 basis points in the second quarter. I would put it at June. I'm on the conservative side, and then 2 more rate reductions coming in the remainder of the year in the second half of 2024. So what that means is that not only are those rates coming down, but other short-term interest rates, borrowing rates will be coming down as the Federal Reserve reduces their target on the federal funds rate. So anybody that's thinking about expanding their business, borrowing money to expand their business, should probably get going on it right now, because at the time that it gets around to finalizing the loans, the terms of the loan, as well as the interest rate that's going to be charged on the loan, the interest rate is very likely, based on what we heard from the Federal Reserve this week, to be lower, and particularly when you get to the June and then, of course, the second and the third and the fourth quarters of 2024. I might add, Jim, what's really important is that we're not only talking about 3 rate cuts in 2024, but they're talking about, or they're hinting at, the very strong possibility that there'll be 4 reductions coming in 2025 and 4 reductions coming, or 3 reductions coming in 2026. So there's further reductions coming, and that's going to obviously benefit anybody that's borrowing money to expand their business. So simply stated, lower interest rates, and if you're going to borrow money, it's good to get started on it now. There's going to be a lot of borrowing that's going to go on in response to what the Federal Reserve has said.
Hugh, you mentioned that the Fed kind of caught everyone by surprise. What are some of the economic trends that they are seeing that led them to make this announcement?
Well, there's 2 things that led them to make the announcement. First of all, their primary focus this year has been on the rate of inflation. And we've seen inflation numbers, consumer prices, producer prices, the personal consumption expenditure price index, which is the one they watch most closely. We've seen them all trending downwards. In other words, they all are coming down. And so they're pretty happy. They're not completely happy, but they're somewhat happy that the trend in inflation is coming down, although they would also argue that it remains somewhat elevated, sort of hinting or suggesting that they're not going to be in too much of a hurry in reducing rates in 2024. That's one thing. And the second thing is they're seeing the economy in the process of slowing. We saw that certainly in the employment numbers for the month of November. We saw an increase of 199,000, but of the 199,000 increase in non-farm payroll or employment, 38,000 of that was because of people that were on strike, the automobile sector, going back to work. So that number was really closer to 150,000 and maybe even a a little bit less when you include the revisions to prior months. So I think it's a combination of the economy is in the process of slowing. That bothers them. They do want a soft landing. They do want the economy to slow, but they don't want it to turn down. So they see it slowing down. So I think that's one of the reasons why they're talking about lowering interest rates to make sure that we don't have more than a soft landing, a recession.
And we've seen, Hugh, on the lending side, there's been a slack in demand for borrowings. And I think a lot of banks have either come to the conclusion that there's either softness within the economy that's leading to reduction in borrowing, or there's just an awful lot of pent up demand that's sitting on the sidelines waiting for positive news like this to happen before investments are made and capital investments are able to be realized. Do you have a sense as to whether one or both are appropriate?
Yeah, we're clearly in the process of slowing, and there's no question there's so-called pent-up demand, or a lot of businesses that I see have postponed their capital spending as well as their borrowing to finance capital spending plans. So that's a lot of businesses doing that because they've obviously been affected by the increase in interest rates and the high level of interest rates. So this is really good news for them. This is news, the kind of news that they've been crossing their fingers and hoping for, and now it's coming. The Federal Reserve has pretty much told them that, look, now you're going to get rate relief, and you're going to get it in 2024. There's likely to be 3 reductions in 2024. You can't get the timing precise, but if you get started now, as I say, by mid-year, third and fourth quarters of 2024, we'll see lower interest rates. And I think some of that capital spending, that pent-up demand that you referred to, is going to start to come to the fore, and you're going to see loan demand pick up fairly significantly in the second half of 2024. That's included, I might add, in the economic forecasts that we're seeing from the Federal Reserve. They're implicitly seeing a pickup in the economy in response to the lower rates, and we're going to see that as we move into 2024, late 2024 and 2025. Stronger demand.
So you mentioned soft landing, which I think everyone has kind of looked at with a great deal of skepticism that it could ever be pulled off. Is it safe to say that it has, in fact, that they've been successful in pulling off a soft landing?
Well, that really is a great question, Jim. And so far, you'd have to say yes. We had an unsustainably strong growth in the third quarter of 2023. That was 5.2%, subject to some revisions. That looks like the fourth quarter, the one we're in, is going to be around 1.5% to 2%. That's let's call it an educated guess. And it looks like the first 2 quarters of the next year, of 2024, might be also very soft numbers, something around 1%. Economists like myself have been wrong on these forecasts, estimates, for quite a long time now. But we're hoping that we're going to be about 1%, maybe first quarter, second quarter. And that, of course, will encourage, shall we say, the Federal Reserve to move ahead on their reduction in interest rates. So I think they're going to pull it off, soft landing. But there are plenty of reasons. Leading indicators, Jim, which you know have been declining for 19 successive months. Looks like a 20th successive decline coming up. They've been telling us that the economy is not simply going to land softly, but it's going to have a hard landing. But right now, it looks like the Federal Reserve is going to be successful. It's going to be a soft landing, but just cross your fingers on that one.
Those are wonderful comments. Is there anything else that you think, obviously there's plenty of problems in the world that could really undo what we see as these trends in the next 12 to 24 months?
Oh, yeah, there's always risk in everything, and there's always risk in expectation or forecast that the Federal Reserve is going to lower interest rates, because a lot could happen. We could see a turn in inflation. We could see the economy pick up unexpectedly, and they could back away from doing any reductions in interest rates. But I doubt it, seriously. I think that the consensus, the very strong consensus among very able-bodied and very clear-thinking economists, is that we're going to have a slowdown. Maybe a fourth quarter, first quarter, second quarter will pick up in the second half of the year, and that will be when the Federal Reserve will sort of step in to try to help the economy by lowering interest rates. So I think this one's a shall we call it, I hate to use the expression good bet, but I think it's a good bet.
Hugh, what does all of this mean in terms of the outlook for the stock market in general over the next 24 months?
Well, the first thing you look at is the Fed funds rate or what the Fed does. And if they lower interest rates, that tells you that the yield on a 10-year treasury is going to go down even further. It's come down already from, say, 5% to a little bit below, roughly 4%. I have it coming down up to 3.5%, maybe 3.3% if the Fed keeps following through on lowering short-term interest rates. So if you have long-term interest rates as measured by the yield on a 10-year treasury coming down that much, and that's pretty significant, that's really good for the stock market. And it really means that the stock market will do better. If you were to ask me, do you think the stock market's going to get to 5,000 from its current level of about 4,800 in the next couple of years? I'd say I don't like to call anything a sure bet when it comes to the stock market. But believe me, I think there's a really good chance. You've got a great configuration of inflation, interest rate, and earnings events coming at us that are going to be really good. And don't forget, earnings are going to be good for 2024 and 2025, much better than people expect.
That's great. Hugh, thanks so much for your time today. Really appreciate it. As always, you've been a wonderful supporter of our company through your board representation, and your economic outlooks are always very appreciated. So I know everyone out there is going to appreciate hearing your thoughts. So thanks again very much.
It's great working with you.